Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, March 4th, 4:51 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show. That's the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at key levels for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. State of the market. We're in a consolidation, bearish consolidation, 7 days off the bottom. So today was the expiration for the quote unquote sweet spot that we look for a follow through day, which is a signal for re-entering the market. We did briefly re-enter some last week, early this week, got stopped by Tuesday or Wednesday, and the vaunted follow-through day simply did not show up this week. We'll take a look at some charts here momentarily, and you'll see what we're talking about. So let's go to the trend gauge over here. Market leaders still neutral, arrow pointing toward bearish. 7 of the 21 on the 21 over 21 list came off this week, and some of them broke down miserably. So certainly not a bullish situation there. We'll take a look, obviously, with the 21 over 21 at the end of the video. And across all three time frames on the major indexes, the short-term 21-day moving average, the medium-term 50-day moving average, the long-term 200-day moving average, all of the 5 major indexes are trending below these 3 key levels. So bearish across the board there. As you might imagine, if you've been listening to the videos, you know we're cash heavy right now. We were all cash until did one buy today, and an oil stock at a good risk reward level. So what happened today? Bears win the day, but the bottom of the range held. Big battle going on today. We'll take a look at the big W formation that you'll see on a 5-minute chart. Every time we tried to break down, there was buying. Every time we tried to break out, there was selling. Big battle between the bulls and the bears. So, but on the day, one thing very clear: growth is not in vogue. G6 down 2.1%. ARK continues. ARKK, one of the 6 components, continues to just get absolutely bludgeoned. S&P 500 down 0.8%. Tech heavy NASDAQ down 1.45, Dow down 0.5%, midcaps down 1.6, Russell 2000 down 1.6, broad 60/40, diversified portfolio down 0.68%, GROTECTION barely positive on the day. We'll take a look at the stock that we bought momentarily. So let's get to the charts, but first let's get to the soon-to-be world-famous tail of the tape. And let's take a look at the friendly faces here at Revere Asset Management, protecting our clients' portfolios in unfavorable markets, participating in uptrends. Haven't seen much of an uptrend in 2022. If you're interested in this approach, shout out to any of us by email: Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. All right, chart time, and let's bring up the tail of the tape. So, brief macro look here. Headwinds continue. Strong dollar. In fact, the dollar broke out today. Inflation, obviously, in focus. Fed taper, an issue. Interest rates rising, although pulling back with the risk-off purchase of bonds this week. Rates dropped as bond prices went up. And Russia-Ukraine is continuing to dominate the headlines. Sentiment put call not elevated at 0.95. VIX high at 32, up 5% today. Got as high as 34.65. Fear and greed down 5 to a 17. That's extreme fear. So our bull case, always got a bull and a bear case here. We don't argue with the market. Initiating a rally and reclaiming the key moving averages. We got the rally off the bottom starting on 224, but have made really no progress since then. A couple of fits and starts, but as I mentioned, we got stopped out, basically back to where we started when we put some capital back in. Bear case, this happened on 217 when the S&P broke back below the 200-day moving average. Let's go to take a look at the S&P now very quickly. Here's your 200-day moving average. Here's 217 when we broke back below, and the bear case took hold. And you can see we've had a big washout since then on 224. At that point, we were stretched almost 10% down from this red line. That's the 50-day moving average. Historically, that's about as stretched as you get before you snap back. That was followed up the next day with some buying. We took a couple of positions. They couldn't get much higher. We got stopped out here on Tuesday. Little try to poke back above this declining, this green line, this 21-day moving average. When we're above here and it's uptrending, and preferably when it's above the 50 and the 200, that's when we want to be the equivalent of all in poker, you might say. This is when we want to be maximally allocated to the market. History just shows when you're trending strongly above the 21-day, good things happen. So, but yesterday we ran into this declining 21, failed, gap down this morning because overnight, let's get back to the news here. Gap down, Russian bombed and then seized the Ukrainian nuke plant. There were some fear-mongering tweets and announcements that came out of that, but no nuclear accident or anything like that. But overnight, we dropped down to 42.85. Remember this is going to be a key level, 42.85. It was down 1.8%. By the time the markets opened, that had been paired to an 0.8% loss. Pre-market, we had a strong jobs report, no wage inflation was really the good sign there. And what I was watching coming in today was the S&P and the Qs. Could they challenge their overhead 21-day exponential moving average where they failed on Thursday? With the gap down, they didn't even get a chance to test it. So what happened on the day? I said the gap down 0.8%. There was a W pattern battling back and forth. I'll show this on a 5-minute chart here. So you can see the gap down here. We were actually all the way down here overnight, this 42.85-ish area, which we did test during the day, and it held there. So for now, that's a low that's been tested twice. Let's go out to a 60-minute chart here, and you can see this 42.85-ish area has been support, with an exception of some breakthroughs and then snaps back to the upside, namely here and here. Those are the two big washout days. This 4280 to 4300 has been pretty big support on the indexes, and that's where it held today. You can see this is actually a kind of a tight range relative to the way we've been trading lately. So here's the W pattern. You got the gap down. We continued lower. Things were looking terrible. Up, we hit 42.85. Let's try a rally. Got to the upside, 43.40, which is the bottom of yesterday's range. Failed there. Another attempted sell-off. This time, 4,300 came to the rescue, and a little bit of a move into the close. To close at 43.30-ish, exactly 42.20, 43.29 to be more precise. So good news if you're looking for some, that 4280, 4300 area continues to hold. 4285 overnight, I mentioned down here. The prior range from this shakeout day, the first shakeout day, which was on 124, we've had two of them, 124 and 224. That range, the bottom of the days of that range are basically about 4290-ish, and that's where we continue. We had one close above it here. The next day we had the big washout and then closed back inside that range at 4288. So that 4280 to 4300 is big support. Look at all the way back here in September and October. It was support there, and it was kind of a breakout area here. If you look back to June and July. So very big area. We don't want to see that break through and have any sustained momentum to the downside. So that's, if you're looking for some good news in an ugly market, I'd say that's what it is. So notes, US dollar broke out. Let's take a look at the chart of UUP, which is an ETF tracking it. And you can see the break above this range here. Tried to break above last week, failed, popped back above it today, did close at the bottom of the range, but strong dollar, not good for stocks. Bottom line it, well, US dollar breakout, second day of tech selling for money moving into defensives, XLP, UV, and RE. That's staples, utilities, healthcare, and real estate. Let's go through those charts real quickly, and you can see how those have been up. Let's start with XLP. Not a good day yesterday. What is going on here? I got a flaw there. All right, so XLP, ugly day at the beginning of today, but closed at the top of the range. So XLP and showing relative strength this week. Really, this has been showing relative strength during this entire correction. Next one, XLU, utilities, big day. Breakout above this double bottom. Also note the relative strength over the last couple weeks. Defensives again. XLV, healthcare. Strong the last couple of weeks, 2 days positive. For 2 bad days in the market, these are basically positive each of the 4 days. XLRE, the last one, real estate. Not the best looking chart, but relative strength over the last 3 weeks. So what we're seeing is not so much, from an S&P 500 standpoint anyway, is not as much an exit of the market as we're seeing rotation out of anything tech, namely XLC, communication sector. Terrible relative strength there at the bottom of the range, and note how this is well below the prior shakeout of 124. So XLC, terrible relative strength. XLK, this is tech, not quite below. You can see the shakeouts, but certainly not doing a good job on a relative basis. You can see it trending down there. And XLY, Tim talked about this on the podcast this week, consumer discretionary, just terrible. Again, at the bottom of the range underneath the initial shakeout, relative strength has been terrible. So it's more, that's why the S&P is holding up much better, and the Dow also, because it's not tech heavy. That money is flowing more into not exiting the market, not fleeing the market, but moving into the defensive sectors. So bottom line it, bearish action, but bulls hold the bottom of the range. That's going to be very critical for next week. If you take a look at the key levels here, let's get back to the S&P 500. Range low support, one of the few green colored comments here, 4290, the bottom of that range, and then today's close, defensives lead, but the bottom of the range held. And then the 2 other lows beneath where we are, 4223, the shakeout low from 124, and 4115. That was the big gap down with the initial invasion and the shakeout that led to the most recent rally attempt, but not really making any progress there. So there's your S&P 500. Let's go to the rest of the indexes first. We'll go to the NASDAQ 100. Closed below this range that it had been trading in for the last week. So again, relative weakness there. It's tech, so it's being sold. You can see Thursday ran into the declining 21-day and failed there. Dow Jones Industrial Average, again, failed at the 21 there. Relative strength-wise, going more sideways than down. You can see trending up here, taking a little bit of a breather there. Recently, as banks have been getting hit, there's some pretty big financial weight in the Dow relative to the S&P. Let's go with mid caps, NDY. Below all the moving averages. 2 closes above the 21 this week, ran into the 50 and failed there, back below the 21 in IWM. Small caps. Couple closes, well, 1 close above the 21 Wednesday. Really playing badminton back and forth with using the 21 as a net, but 2 closes below now. So not a lot of good things to take away from looking at the indexes. And the key next week that we want to focus on is the bottom of this range, this 4280, 4290, 4300 area that's been holding. If that gives way, then we've only got the spike lows from 124 and 224 to provide support. So look out below should that happen. So let's get to the 21 over 21 now. Let's see here. So first thing we always do is show the 7 stocks that were punted from last week. I'm going to start out with three of these we owned at the beginning of the week, and this is why we obey our stops. Expedia Expedia, you can see here, once it broke below the 21, last 2 days broke the 50-day moving average, and you just got to get out of the way of these things. I mean, this had been holding up very well from a relative strength standpoint, but then rolled over badly. So stopped out of Expedia, also stopped out of Datadog, and this clearly broke the 21 and the 50 and held the 200 day today, and also stopped out of Docs. And this is why there's a perfect reason why you want to obey your stops. Down 14.5% today after breaking the 21. 21 is so key. I can't stress it enough. So that's 3 that got punted out. Another one, didn't own this, but an apparel manufacturer that drops 15% on no news that I could see, but once the 21 gave way and it headed, it was just in a free fall all day. So Capri, say goodbye to that. Robert Half, this is commercial services and staffing, holding up pretty well, but broke the 21, bounced at the 50-day moving average, still staying on my list. GLW, this is one that I had high hopes for. Great earnings report, pricing power. They said, but it just rolled over along with the market, heading lower, breaking all the moving averages. You got to obey price. It's the only thing that really pays. And finally, Schlumberger coming off. It's an oil stock, but it has a lot of Russia exposure from some research that we've done. So that kind of explains why that's been lagging. Closed actually right on the 21, but we replaced it in the 21. Let's go with the first stock that's taken over there with Halliburton, which has less Russia exposure and is showing relative strength, line continuing to trend higher. One of the few oil stocks that isn't extended. Oil's got a lot of different sectors to it. There's midstream, there's fracking, there's refining, but the refiners have kind of been lagging lately. And speaking with somebody that's an expert in the field, one of the reason the refiners are not doing so much is one of the issues is different refiners handle different types of crude, and Russian crude, if it's coming off the market, requires a different type of equipment than some of the other grades of oil. So that's one theory as to why the refiners are not doing as well as the rest of some of the stocks in the oil patch. And then I mentioned services. Also, the producers have not committed much money to CapEx. You remember last time when fracking took off, there was a bunch of build out. Then Saudi Arabia flooded the market with oil, drove the price of oil down. A lot of the newer exploration and production companies went bankrupt because of all the money that they invested. They couldn't meet their loans, and it's one of the reasons why oil services is lagging right now, because there's a reluctance to increase production. You've also got an administration that's not exactly friendly to oil. Okay, so let's get into 21 over 21. These first 7 are going to be 7 that were added to the list this week, and I don't know what is going on with my screen here, but anyway, one of the few semiconductors holding up here, and it's a relatively new IPO, good growth numbers, Global Foundries, very clearly above the 21, showing some relative strength. PSA Public Storage, this is a REIT attempting to break out, great relative strength there. Union Pacific, rails continue to be healthy. You can see the breakout here failed yesterday, but followed through to the upside today. Heavy volume for 2 days on that. Dollar Tree, big shakeout on its earnings report, but closed at the top of the range. Follow through on day 2. Pulled back on lighter volume yesterday at the top of the range. Breakouts haven't been working, but we are isolating strength that's above the 21. Another new name, Lantheus Holdings. Don't know a whole lot about this, but I do know what a good looking chart and volume looks like, along with their growth numbers. Gap up, made higher high for 5 consecutive days before taking a break. We're going to be doing a deep dive into this to see what's going on with that explosive earnings growth. Box, another tech stock, one that's holding up well. Tried to break out on this gap up move on earnings on Thursday, but pulled back, but a nice inside day showing some strength. today. Anything strong we want to keep on the list in case the market rights itself. Usually those strong stocks are some of the first to move out. And also, it's only got a 31 PE with a 33% growth rate for 2023. So we are paying attention to valuations. And then Halliburton, this was number 7. Already went through that chart. And the one stock that we own in house today. So Palo Alto Networks, there could be could also have Checkpoint. You could also have FTNT on here. We don't want to overload it with one sector though. We've got 15 broad sectors and 21 industry groups represented. So just one stock in each of the 21. That's how you get your diversification across industry groups. You don't have to be buying the horrible charts of emerging markets or international stocks. Okay, so Palo Alto, pretty good there. Mattel continues to hold up well, just really going sideways, met up with its 21 today now. Newmont Mining, this thing just broke out with strength today. So there are some sectors where breakouts are working, but if you're not in oil, if you're not in gold, if you're not a fertilizer stock or a cyber stock, the strength is getting sold. Nucor steel stock continuing to trend higher. LNG, big gap up, a couple days consolidation, now new highs. Arch, coal, this is another area. Arch and BTU just with great moves this week. MPC, this is a refiner still holding its 21, but not showing relative strength versus some of the other oil stocks. Archer Daniels Midland, agricultural commodity service company, all to new highs. LMT, Lockheed Martin. You could also have Raytheon on here. General Dynamics, Harris, that's LHX, and Northrop Grumman. Those 4 or 5 are all looking fine. LMT's been on here for a few weeks. AbbVie continues to look good. Just every time it touches a 21, it bounces off it and continues to head higher. Berkshire Hathaway, a financial that's holding up. And compare this to something like JP Morgan. There's a lot of fear that these big banks have a lot of more exposure to the impacts of the Russia-Ukraine war than they're letting on. So these really are not looking good. Here's the big bank ETF. You can see it's battling to hold the 200-day moving average. So big banks to be avoided now. Zim Shipping, holding above its 21, been on here for a while, along with CF, these fertilizer companies. Several of these. Mosaic also looks great. And finally, Devon Energy has been on here since it's number 1 on here, number 1 in your hearts, and the longest on the list, consolidating right under this 60 level at all-time highs, and that's your 21 over 21 list. See if there's any other highlights on here. I don't believe there are. I think we've discussed everything. So let's take one final look at the S&P 500 before we wrap up here. And again, the key for next week is holding the bottom of this range. And then if you want something good to happen, we're going to run in again. I mean, look how low. Eventually, the 21-day over the last 3 weeks has gone from 4,500 down to 4,400. It'll keep trending lower. Eventually, we'll break above it and start to form a right side of this base. And we've got our leaders list ready if that happens. But for now, it's just a pipe dream. So that's going to wrap it. As always, like to hear from you. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. Wrapping up the week ending March 4th, 2022. This is Don Vandenbord telling it like it is. Just the facts here, folks. No opinions. Thanks for listening, and have a great weekend.